Good morning. At this point, we would like to begin our presentation by introducing our team.
Hi, I'm Zach Bedell.
I'm Kendra Reisner.
Spencer Moran. As you can see, our fourth member's not with us. He actually suffered a concussion a couple days ago and couldn't make the trip. So,
Seen here is our agenda for going over Stryker with you today. We're going to begin with our investment foundation and then move into the business description of Stryker as a company, and then further go on to do a financial analysis, valuation, and conclude with our investment summary. At this point, I would like to pass it off to Spencer for our investment foundation.
thanks, Kendra. So we recommend a buy of Stryker at a price of $102.92 and a premium of 16.63%. We recommend this buy because Stryker has strong growth potential as well as emerging markets in international sales and revenues, and also a strong presence in their market. Next, I'd like to pass it off to Zach.
Thanks, Spencer. So, who is Stryker? Stryker is an innovative global firm that is in the medtech industry and is a leader in the medtech industry. Their focus on innovation, and we can see this most in the Flex financial system, which they use to leverage across their business model, and their focus on quality, which we can see in their customized segment products, which allow them to become specialists in their respective field, as well as extremely customer focused, which allows them to tailor their products to their customers' individual specifications. Stryker operates in over 100 different different countries across the globe. They're still headquartered in North America in Kalamazoo, Michigan. However, they are now as far-reaching as Australia, having an office in Sydney. They have won numerous awards, both as a great employer and also in the medtech industry for innovation, and they are a Fortune 500 company for the 13th consecutive year. At this point, I'd like to hand it back to Spencer.
Thank you. So, Stryker has a very strong corporate governance. Customer is the number one priority. Without their customers, they wouldn't be where they are today. They're also a very strong socially responsible company. They do work with numerous charities around the world, especially with underdeveloped nations. Next, I'd like to dive into the financial analysis. So these revenue models, on the left, you'll see a breakdown from U.S. and international sales. Most of their market is in the U.S. However, they have a growing presence in the international market. On the right, you see the breakdown by segments, as Zach talked about. The med-surg in their neurotechnology. Well, the med-surg and the orthopedics are the bulk of their business at 80%. The neurotechnology is just under 20% at 18%. Next, I'd like to give it to Kendra.
Thank you, Spencer. Earnings per share for the forecasted period are projected to grow at around 18% annually through 2020, at which point we believe they will begin to slow until they reach a rate of around 5%, which we believe is a long-term sustainable growth rate. This high level growth can be attributed to high growth in revenues driven by entering further into these emerging markets and increased sales in places like Europe where they already have a strong growing presence. Moving on, statement of cash flows. Here, historically, Stryker has used a majority of their free cash flows in mergers and acquisitions and or paid it out to their shareholder as a dividend. In 2011 and 2013, they had high levels of M&A. Moving forward, we expect free cash flow from operating and investing activities to increase, which will further then drive the increase in total discounted free cash flows that you can see here. At this point, I'm going to pass it back over to Zach to look at the gross profit margin.
Thank you, Kendra. Stryker's gross profit margin is relatively high, and we project that it will continue to do so based off of our financial estimates. We believe that it will continue to grow at a rate of 5% for up until the year 2020, and we believe that this is mostly due to the fact that it will have continued increase in sales as well as increasing economies of scale. Moving on to their financial ratios, Stryker's current ratio is very healthy at this moment, which represents the amount of leverage that they have, as well as their liquidity. Also, their asset turnover ratio, which is a measure of the company's efficiency, is very not only consistent, but it also demonstrates that Stryker is a very efficient company in using the assets that they already have. Stryker's debt-to-equity ratio is very good, especially in comparison with industries in the field, and also their return on equity is also very healthy, which we believe mostly is due to the fact that they're increasing increasing in sales over the period of years. At this point, I'd like to hand it back to Spencer.
Thanks, Zach. So this revenue model, diving into the valuation, what we did was we took the 3 product segments and the main products in each of these segments, and we forecasted their revenues through 2020. We believe that this is a key indicator of where their revenues will be going. So what we did was we took an 80% weight in the products within each company sector, and then we took a 20% rate in the U.S. and international markets, and that's how you see that graph. So next, I'd like to talk about the sales. So we see a solid sales growth of between 6 and 7% through 2020. This growth in sales will be key for net income, gross profit margin, and earnings per share. Next, I'd like to give it to Zach.
All right, so one of the models that we used was our free cash flow valuation. So how we calculated that was we used the risk-free rate of 2.06% based off of the 10-year Treasury bond. And we believe that based off of this, we continue to see that Stryker has a relatively high growth rate. And we expect it to continue to do so in relation to their sales up until the year 2020, where it will begin to taper off. But by the year 2024, we expect that it will continue to remain at a 5% increase rate. Our next valuation model was a dividend model, which historically speaking, Stryker has had very high dividends. And we expect them to continue to do so, especially in relation to their earnings per share. As their earnings per share increases, so too do we expect that their dividend ratio will increase as well. Now I would like to hand it back to Kendra.
Thank you, Zach. So Zach just told you guys about the models that we use. So then in coming up with the target price we showed you guys earlier of 102.92, you can see here these are the 3 target price from the models we use that we believe most strongly represented where Stryker was heading. So we took a weighted average of these, and that is how we got to the 102.92 and the premium of 16.63%. So in summary then, I would like to draw your attention to the center of this slide, and that is that we recommend buying Stryker based on everything we have shared with you guys today. At a price in the market of $91.14, it is undervalued. With the target price of $102 that we came up with for year-end 2016, the organic growth rate of 5% is almost guaranteed based on the last few years of what the company has been doing and their plans for this future in 2016, what they've already talked about, and this just further endorses that buy recommendation. This concludes our presentation. We'd like to thank you and open the floor for questions at this time.
You mentioned that you came up with your target price by using a weighted average of the 3 different valuations. How did you weight those, and what were the weights?
Okay, so I can go back. So because free cash flows has been a big use of the firm, that's the center one there, and we took a 70% weight of that because mergers and acquisitions is big for Stryker. That's something they spend a lot of money and focus on, and then the rest of their free cash flows has often been paid out in dividends. So it kind of they tie together then because the dividend models are coming from that, but we believe that that was the most accurate representation. So we took the 70% from there, and then one was the top there is the 2-stage basic dividend discount model, and then the bottom is the H model, and so then we took the other 30%, 15 and 15 from those, and that's how we got to 102.
You mentioned that Stryker spends a lot of money on M&A, and I think you said they've been growing organically 5% sales, and I think you said that for your valuations, you guys were looking at 6 to 7% growth.
Mm-hmm.
So are you thinking that they're going to have 5% organic growth going forward, roughly 2% via M&A? So their growth rate may be split between organic and also the M&A. Will that slow down over time?
Yeah, we say it was through 2020, and then after that point, we see it slowing down a little bit.
Okay, if you were the CEO of the company right now, and if you were looking at firms to buy, what area within Stryker's business would you focus on right now to earn the best returns going forward?
Oh, sorry, go ahead, Spencer. No, well, currently, right now, we've seen the greatest growth in the med surg industry, and we have looked into the fact that a lot of their acquisitions have been towards creating better products, especially creating them more efficiently, and allowing, especially their customers, to be able to customize them to more specific specifications, especially internationally. We're seeing a lot of this growth overseas, especially when we're dealing with different climates, as well as different levels of hospital care.
What is med surg growing at, like, versus ortho right now, versus orthopedic, as far as growth rates?
If I could jump in there.
Yeah, sure, go ahead.
I believe the med surg itself was around, it was like 8.5%. And so then orthopedics was slightly smaller at around 7%, like for the past like few years.
And which of Stryker's segments has the best operating margins as far as most profit? You look at gross margin, but were you able to focus on operating margin at all?
I think we put our focus on the gross margin, if I'm being completely honest there. But one more thing, going back to, if I could just add quick to your other question that you had originally asked, of like what area you should be looking at. I don't know necessarily that I would say just one product segment area either, even though it's growing. What the thing is looking at key firms that they can merge with and or acquire, because they keep trying to grow internationally and into these emerging markets, and it's to find firms that are developing the services and like these products that they believe will be able to like sell over in those markets so that they can keep growing internationally and further that, because that's where they're very stable and sustainable in the US already, but they have a lot of room for potential growth internationally.
I like the organization of your presentation, by the way. It starts with the thesis, ends with the conclusion. If all my students could do that, I'd do that. So good job. I had a question on the cash flow slide, not your valuation, but the right. So you had earnings and then cash flow. It went by fast.
Yeah.
No,
think it's
discount.
this one?
Yeah, statement of free cash flows. All right, so on the left-hand column there,
Yes.
we see the anomalies in 11 and 13, and obviously what we're looking for in the model is forward earnings power, and you've got things kind of smoothed out a little bit. But
Yeah.
as an analyst, how do you make the adjustment to, first of all, reported earnings and adjusted EPS, that their target ranges are quite different in this coming year, and in the free cash flow? So what adjustments do you make in your model to handle that?
So with this, well, the one that on the left here that you're looking at,
Yeah.
through 2015 that data was given. So like moving forward, the ones you see are the projected like growth rates that we believed based off of our revenue model, and then looking at the statement of cash flows and taking it as like a
Okay,
percentage
so when I
of
sit
growth.
down to do my forward, I look back at the last 5 years and say, all right, so what's a normalized run rate of free cash flows in the past 5 years? So how do you get to that? If I asked you between 2011 and 2015, what would you consider their normalized free cash flow?
Okay, so we went back when we did this, we didn't include it, but we went back a little farther because 2011, 2013, because it was negative there, then we looked, and it was because they had high levels of M&A there. And so, I mean, if we believe that they haven't talked about like doing that high level again like recently in these like next few years. And so looking back, like before we went back, I think to 2009 before to like looked at that, and then also looked at the discounted free cash flows for those periods too, because 2011, 2013, the negative number didn't accurately like represent like the normalized like where they were going with that.
Okay.
We also took into account the value of these M&A purchases, and we try to adjust it based off those, so we can get a more realistic look at what 2011 and 2013 would have looked like without these abnormalities, basically.
Okay. And now I'm going to challenge you on a statement you made about the gross profit margin increasing. You may be right, but I just want you to justify it to me.
Sure.
Under this context, one of the things to not like about Stryker is that they face pricing pressure all the time. So
Yes.
as they report, they say, unit sales were up 6%, but we had minus 1.5 pricing effect. So is that pricing effect on the ortho side a concern for you? And given that pricing effect, how can you project increasing gross profit margins?
Do you?
Yeah, well, it's very difficult to account for that, simply because especially when Stryker goes into international markets, you're not sure, based on the different markets, what type of pricing influence that you'll receive in that part. So what we did was we looked at the individual sections, and when we broke down Stryker into its segments, and we looked at what potential pricing effects it has on each particular segment. And then we took that into account into our gross profit margin. For example, if they did have the negative 1%, we would actually add that into the model so that we could project it, so we could have a more conservative estimate based off of our gross.
Yeah,
gross
also,
profit.
if I could expand on it, if I could
Yeah,
draw your
sure.
attention back to this, you see it's growing, but at a very small rate. It's not, the gross profit margins aren't growing at the 5% rate that we expect sales and revenue and everything else is.
Yeah.
It's, the key with the gross profit margin is the long-term sustainability here that's being represented by keeping it growing, but not at an obnoxious rate. And with the increased economies of scale and their business focus, they can kind of avoid some of those pricing issues because they're narrowing their product focus, and they used to have a lot higher inventory, and they've actually like reduced some of that and kept everything focused. So as the economies and scale increase, it allows them to keep this like stable but like slightly increasing gross profit margin.
Thanks. We have a little time left.
Yes.
Go ahead and use it. All right. We've almost beat this to death, but I've asked this to every team, so we'll see how your answer compares.
Sure.
When Stryker makes an acquisition, they don't always talk about what the results of that acquisition are going forward. So it's hard to extract. So they made the Mako acquisition. How much was it worth? How much are they making off Mako? They don't tell you. Broken out. So how do you evaluate the success of their M&A strategy?
Okay, and that was actually kind of one of the questions we had when we met with Stryker, is what they were doing, because they also like expanded into China. They acquired and merged with the company Trazen. I'm probably butchering that name there. And so they kind of talked about their plans for what they're doing with that. So then we kind of like took back and looked at everything else that they're doing and like with their business model, and look at how those mergers and acquisitions fit into their business model then, because then we project the revenues and the sales from the M&A, like how that's going to help them grow and increase based on their business model, because once they merge and or acquire with that, it's going to be their business model that's kind of like running that company, if that makes sense.
All right. Thank you.
Thank you guys.